Iliad is pleased to report a solid set of results for the first 6 months of 2014. Comparable store revenue growth is at 4.6%, reflecting the fact that the business environment, specifically the industry environment, remains intensely challenging and competitive. Certain industry indicators show positive trends. It's encouraging to see that building plans passed are continuing to improve. Also, mortgage loans with regards to existing and new buildings showing slight improvements. Having said that, macroeconomic factors such as lower GDP growth, an intense and a tough labour environment, an increasing inflation rate environment, and also what looks like an increasing interest rate cycle, all of this impacts directly on our industry. So in this context, with industry inflation at between 4 and 4.5%, the 4.6% revenue growth to us is acceptable in this environment. We did manage a gross margin percentage recovery, not necessarily because of any specific developments in the market, but mostly as a result of internal inefficiencies. It remains encouraging though, and we look to sustain that going forward. In a difficult trading environment, expense control remains of the paramount importance, and we're pleased to report that expense movements are within inflation and under control. And all of this adding up and resulting in a significant operating profit and earnings improvement, with earnings per share and headlines earnings per share at more or less 30 cents per share. The context is important though. Iliad made significant portfolio adjustments in 2013, selling off 3 businesses. The result at the interim is driven by the fact that the benefits that we targeted with the sale of those businesses have been delivered on. If we look at the EBITDA line, comparable stores shows marginal growth, again a reflection that our business environment remains tough and challenging. The interest line, net and finance costs, our net borrowings level is down by approximately 59 million from the comparative period, mainly as a result of the disposals, and that is reflected in the net finance costs, which is down on the prior year. Tax rate at 23%, and flowing from that, a contribution to our earnings result. As far as the balance sheet goes, the lowly geared balance sheet reflects a healthy position and creates the platform and enables us to take advantage of opportunities to expand as and when that provides themselves into the future. Growth going forward will have 3 avenues for us, 3 slants. Organic growth, as I commented on, will not be exponential. I'm pleased to report that from a new store perspective, 2 new stores will be opened before the end of 2014. And we will consider appropriate acquisitions as those opportunities present themselves to us. From a key initiative process, very excited and pleased about the progress we're making on building brand equity in our Buco brand, newly launched during the course of 2013. And a big milestone was achieved at the end of July when we completed the comprehensive process of integrating all of our stores onto a single platform. Branding changes, IT platform integration, significant portfolio adjustment in recent times. All of those creating a sound position for us from which to take this business forward as we move into the future. Again, however, the context of top-line improvements expecting to be gradual for the balance of 2014 and as we move into 2015. Reflecting a bit more on our industry environment, the competitor set remains intense. There's strong competitors, a fragmented industry, significant independence. We trust that as some of those macroeconomic KPIs that I touched on earlier shows improvement and enhances the environment in terms of growth expectations, that will spill over into the building material supply industry and create more significant opportunities for growth on the medium to longer term.